you on a variety of trading and investing ideas. Today's session, get paid to buy stocks, naked put strategy explained. Now imagine visiting an auto dealership and you pick out a car that you want to purchase, but unfortunately the sticker price is more than you're willing to pay. However, the dealer tells you that he'd be willing to sell you that car at your price if he can't sell the car in the next 30 days. And because of your willingness to purchase, he's going to give you a $500 cash advance in order to hold you to that obligation. The catch being, if the dealership exercises the purchase price agreed upon, you must buy the car. But if he doesn't, or he sells the car before the 30 days is up, then you still get to keep the $500. Too good to be true? Hello, everyone. My name is John Rowland, Barchart Senior Market Strategist. And well, I'm here to tell you that the naked put option strategy mirrors our auto dealership scenario. A put option gives the owner the right to sell a specific asset at a specific price up to a specific time. A put seller becomes obligated to purchase the same asset at the designated price and time. The owner of the put, the buyer, pays a premium for that right to sell, and the put seller receives or collects that premium and takes on the risk of the underlying asset falling to the chosen price from transaction to expiration. Now, the put seller keeps the premium even if the put purchaser does not exercise that right to sell. Almost too good to be true, but it is. The naked put strategy, let me go to Barchart for a second. The naked put strategy is an income strategy. And because if it is successful, the put seller, you, keeps the premium collected without taking ownership of the underlying. However, some put sellers will use this strategy to discount the purchase price in the hopes of ownership. So put yourself in a comfortable position as I demonstrate Barchart's naked put screener, the filters, tools, and features that can help you exercise a potentially profitable probability with the right combination of strike selection, time, premium, and risk assessment. Now, before we get to all that, please welcome our moderator and Barchart's project director, Gene Baker. Hello, Gene.
Good afternoon, John.
Good afternoon to you.
Yeah, going to learn all about naked puts today from you, I see.
Yeah, when I have my grandkids, we always run around, naked baby, naked baby. So every time I hear naked, I always think of that. So it's kind of funny. I know it's
no naked babies here today, just naked
no
puts.
naked babies,
okay?
just naked. All right, you ready to get started?
Absolutely.
All right, thanks, Gene. All right, so I want to remind you that today's session is for, oops, wrong one. Here we are. There we go. Today's session is for educational purposes only, and that the decision to buy, sell, or trade equities, stocks, commodities, or other investments involve risk and invest made on the advice of a qualified professional. And I want to also add that options trading is not for everyone, and certainly the naked put strategy has the potential to create significant losses. And so under no circumstances shall we be liable for any losses or damages that you incur as a result of trading or trading activity based on any information or material that you receive through Barchart and Barchart.com. Okay, let's get back to our screen. So let's jump right into it. So again, under options, here we go, income strategies, naked puts, and that is this page. And as I said to you, the strategy is an income strategy that we hopefully will allow us to collect a premium, then we will not be obligated to buy. Now, on this page here, there is a couple of tools here I want to point out to you. First, there's the Learn More tool. And if you click on that, that's going to take you to this page. This is more of like a textbook definition. It gives you a little bit of some examples. There's an accompanying video. So again, some additional learning material. Also, there is more resources, and you can see here naked pics. And this one will be maybe a little bit more advanced from, let's say, the beginner level. So I just want to point that out to you. Okay, so the screener, the naked put screener, screens across markets looking for candidates based on some predetermined inputs or filters. And they range from days to expiration to out of the money probability. Now we can use this as a jumping off point. This is not an all cut in stone. As you become more proficient in your decision making process, you can modify a lot of these inputs. But again, some of these are intentionally left blank for comparison purposes, and then others are designed to narrow down the field of candidates. A great example would be security types. Here we're just looking for stocks where we could, look at ETFs. So let's go back to the results here. And I'm going to go up here to the right-hand corner where it says help and this little question mark, and I'm going to open that up. Now, if I open that up here, there is a webinar, one that I produced over a year ago, based on this concept of naked puts. Unfortunately, that one, and the reason why we're updating it today, is it doesn't have these new features that we're going to demonstrate for you. But again, the ideals are pretty much the same. But here you can get a little bit more detail about how the page is constructed and the details of the different filters and input strategies. Okay. All right, so let's walk through our filter columns. Okay, so first of all, we have symbols, right? The symbol of the contract or the market we're going to trade. Then we have this little graph here, and this is going to be a link to our profit and loss chart. We're going to get back to that. We'll come back to that in a little bit. Then we have price or last price of the underlying, and then the expiration date for that option. Now, I want to point out that the options filter uses monthly expirations. And the reason is, the theory behind that is that institutions tend to trade more monthly expirations than they do weeklies. So this is going to solve two problems or create two benefits for us, is that these are going to be more active. In other words, they're going to have greater liquidity, volume, and open interest. And that's going to benefit us by narrowing the bid ask. The other thing is time, or what we're going to learn is called theta, because there's going to be this balance between the amount of time given for the option and the premium paid. And weeklies typically become active just a week prior to expiration, and they command lower premiums and lighter volumes. Now, I kind of call this chasing nickels in front of a steamroller. I'm not putting down that strategy. I know a lot of options traders use this kind of scenario, but I have seen a trader that picks up nickels for a whole year and have one of these trades go badly on them and give back all of their profits. Strike, that's going to be the price of the underlying that is to be sold if exercised. Moneyness is our relationship to the last price to the strike. Negative red is below last, and positive green is above last. The bid is the price to sell the put now. Now, this is used for calculations. So here's a trader's tip. We don't have to take the bid. Matter of fact, if you sell on the bid, the bid is priced for the market maker. In other words, the market maker will be locking in a profit when you sell at this bid. So you're actually giving away a little bit of profit. So you could do some things like you could middle the bid and ask. You could wait for a down day when puts become more expensive. And we're going to look at an example a little bit later where just a few cents can dramatically improve your return. Okay, the break-even bid is the break-even price, the strike minus the bid, the premium that we collect. The break-even percentage is how far the current price would have to fall in order to reach the break-even price. Volume and open interest, again, kind of self-explanatory. Just know that volume is delayed by 15 minutes, and open interest is just basically how many open positions they are. Now, again, if we're looking at monthlies, again, the greater the open interest, the greater the liquidity. IV rank. So this is the 30 days at money implied volatility, and it ranks it from highest to lowest over the past 1 year. Now, the theory being here is that the higher the ranks, the higher the premiums. Delta. Delta is a measurement of how much of change of our options for every $1 change of our underlying. Now, also, it can also serve as a probability percentage value of the chance the strike will finish in the money. Return. Now, this represents the bid divided by the strike minus the bid, or a percent return of the capital outlay, our cash secure, to the premium collected. Now, for instance, if I had a strike where I had to put up $10 worth of credit and I took in a collateral, and I took in a $1 of credit, well, then that would be a 10% return. Now, as we dive deeper into strike comparisons with our days to expiration and our premium collected, I'm going to give you a bit of a trader's tip or preference, and that is that I kind of strive for looking for 1 to 2% for every 30 days to expiration. And then the annual rate is just the return annualized over 365 days. Now, obviously, most of the candidates will expire before then. So this is just a measuring stick for comparison. And again, kind of that minimum threshold we want to look for is somewhere between 12 and 24%. The profit probability is the probability of the underlying to trade above the break-even point at expiration. Now, if that happens, then we're going to have a successful outcome. And notice the relationship, if I pull this away here, notice the relationship here of delta and profit probability. If you add them together, they get pretty close to 100. Now, the small difference is that delta is to strike, where profit probability is to break even. Now, there are some additional data points that will be relevant to us. Under dividends and earnings, right? Both of these can be catalysts and can also dramatically affect the prices of our puts. And then options view. So in here, you're going to get your Greeks, right? And the naked put option strategy is what is called a long decay or a positive theta. So we want the option to decrease in value, and every day, all things being equal, an option loses value. That is called theta. And we're going to look at an example of that in a moment. Okay, so let's talk a little bit of philosophy of trade and mechanics of naked puts and cash secured puts. So a cash secure put means that the put seller, us, puts up the value of the stock, the underlying, minus the premium collected, in case the option sold becomes in the money and is assigned. In other words, the put buyer exercises their right to sell. So in this instance, a stock, for instance, like Tesla, where are you, Tesla? There you are, Tesla, which, relatively is around $450. So one option represents 100 shares of that stock, and the collateral of one naked put for a Tesla option would be $45,000. Now the strategy assumes that we're trading on margin depending on our broker and how much we have to put up, but it's usually a fraction of the full collateral, generally somewhere around 20 to 25%. But in IRAs and SEPs and all of these retirement accounts, all naked puts are treated as cash secure full collateral. And the screener's basis of returns are on full collateral. So margin returns will be larger because of the leverage, but it does not mitigate you from the full stock price in the event of assignment. So that's the mechanics. So let's talk philosophy. So selling a put or writing a put is about collecting time premium, unless we're selling an in the money put, which could have some intrinsic value. A conservative trader will choose strikes out of the money below current price, effectively choosing a stock price that they believe won't come into play, probability, or a price they feel comfortable with or willing to purchase that particular stock. Aggressive traders who are more bullish or potentially wanting to be assigned the pathway to ownership will choose a strike at or slightly in the money. The difference, the closer to current price, the greater the potential profits, the time value, and the chance for assignment. Okay, so let's do this. To begin our selection process, we're going to start by ranking candidates by strikes and days to expiration. And then what we're going to do is we're going to look for two factors. And those two factors are going to be our highest return. Let's go back to our main view. And let me slide back down here to Tesla. We're going to look at our return, right? Our highest return to our most downside protection, our break-even percentage. Now, in other words, what we want to do is we find low probabilities of assignments, in other words, high profit probabilities, but we also want to start thinking about a minimum, maximum acceptable return, annualized somewhere between 12 and 24%. And as I mentioned before in the beginning, is that my preference is that at least I want 1% for every 30 days to expiration. So profit probability, we want to start looking at amount of strikes that are above 70% or deltas that are below 30. And so when we go for strike selection, I want you to think about two things. Think about where would you be willing to buy this particular stock or equity, and where do you believe that price will not fall below? Now, if price does not return to that limit price, just needs to stay above it for us to receive that full compensation at expiration, that correct call, and we'll pocket that income. Okay, so let's look at Tesla here. And so we see that there's a lot of Teslas that have an expiration of 30 days. Now, I think 30 days is kind of really the perfect sweet spot for setting up naked puts, but you could use a shorter time frame. You just understand that this will create enough time for some nice premiums, but also we're now starting to get inside of that time frame where theta starts to rise significantly. So here's a little trader's tip for you as well. If I sell a premium, right, or a put, and that premium decreases by about 80%, before expiration. Again, let's say I sold a put for $1 and now the put's only worth 20 cents. That would be an 80% reduction. Then I'm probably more inclined to close out that position, because then what I will do is I'll be able to recapture that collateral that I have put up, and maybe I might find a better opportunity where I could get another 80% instead of trying to squeeze that last 20 or 15% of juice. Okay, so let's go to, I want to kind of do this here. I want to show you some skills here. So let's go to filters. And what I'm going to do here is let's just focus in on our Tesla example. So I'm going to write the word symbol, and then I'm going to add it to my screener, and then I just want to look at those that match my symbol, Tesla, and there we go. So now we have narrowed down these by date of expiration and also by strike price. Okay, so there's the next step here we're going to do is how do we do that strike selection, or how do we find the optimal strike and profit potential combination that fits my risk tolerance or my goals as this strategy plays out. So there's a couple things we're going to do here. First of all, this is this little icon here. It looks like a graph. And this is a link to our profit and loss chart. You can also get it over here. Now, if you click on this one here, what it's going to do is going to pick up whatever the first input is, or the first line here. And you can navigate that by this box here, which will lower that to the next combination of strikes and expiration. If you know exactly what you're looking at, for instance, let's look at this 390 put combination. I can just click on that. And once I open that up, this will take me to what is called the profit loss graph. So this will kind of lay out visually for you the profit and loss. The dotted line represents our break-even price, where the stock price has to go, where we will not make any money or not lose any money. And notice that our profit is capped, right? No matter how high the stock price goes, our maximum profit is only the premium that we collected. But below break even, notice that losses do expand, and this is that greater risk to the naked put strategy. All right, so here's the setup. We're going to sell the 390 put at $11.10. The net credit is that premium. Remember, it's $11.10 times 100 shares, or $1,110. And then the debit, $37,890, is the cost of being assigned, or in other words, our net purchase price. Break even, the break even price, and the break even percentage. And then our moneyness, how far is our strike away from current price? Our return, and our return in an annualized, and then our discount if assigned. So this discount is from current price. And then our profit probability, in other words, in this scenario, there's an 78% probability that price will not get to our break even. Okay, we have our Greeks. Again, there's some good information here. I think for Greek geeks will tell me that the main one that we're going to concentrate is theta, that amount of decay on each day for this particular option. And they will tell you that what we really want to look for is that our theta is greater than our delta, and so that when we look at the delta theta ratio, we want to see it less than 1. Expected move. Now, expected move is going to help us with our strike selection for our conservative or setups where I don't want ownership, or that want that ownership risk. what I'm going to do is I'm going to look to set up my strike at the outer edge of our expected move, or at least put our break even below it. So you can see for this one, our expected move here over the life of this option, the downside range is 383.79. Now let's go back to this trade. The strike is 390, but the break even is at 378.90. So again, the strike is a little inside of our expected range, but the break even is out. I think the more conservative you are, you would probably want to choose a strike outside the expected range. So this would put you more in the conservatively expectation, but certainly I think there's still a good probability that you're not going to get exercise. Okay. Volatility. Oh, before that, let's see. Okay, what I wanted to talk about is, earnings. Earnings is definitely an aspect that we need to be aware of. And for Tesla, the reason why I use Tesla today is that earnings are on Tesla, I believe, are coming out this afternoon or right after the close. And so, look at, if you're going to trade earnings, you got to look at what is the average move on an earnings move. And again, think about this in terms of our expected move. I mean, it's only about 2% less, but that is going to happen in a 1 day, where this is an expected move over the next, say, 30 days. So again, the idea of choosing these strikes or strike combinations, this might be a little bit more aggressive based on earnings. But here's the kicker, that post earning days, tomorrow, for instance, for Tesla, you get something called volatility crest. And so post earning events are usually good days to set up these types of naked put strategies. So maybe not today, but maybe some better setups tomorrow, if you don't want to take on that risk of earnings. Oops. Okay, let's go back to our strategy here. Okay, volatility. So you get our rank and our percentile. Kind of the sweet spot here is we want to find a rank and percent, a rank that is in this middle yellow piece or mustard colored piece. I feel like this is kind of the sweet spot, somewhere between 30 and 70. Now, if you get into the higher greens, this just means that you're going to have greater premiums, but also greater price risk. Now, the difference between the two is that a more conservative trader will probably be in this range, where an aggressive trader, or those that are willing to take on risk, will be looking for higher ranks, knowing that they're going to get higher premiums. Now, I think really what we want to look for is a little bit of a combination of both. And so something like our IV versus our historical volatility, we just want to see our current implied volatility above our historical. And that's just telling us that we're getting a little bit more of a put premium. And then trend. So trend's going to help us in two ways here. Ideally, we want to be a bullish trend, right? Think about that, right? A lower chance of falling prices and a greater probability of success. But the second part of this is where our strike selection is going to be located. And this is going to be in a relationship to our moving averages. Again, a conservative trader will probably look at a moving average around the 100-day. And those that are looking for ownership will probably be concentrating on the 20 or 50-day moving average. Again, let's look at this. Notice how our 50-day moving average is at 393.76. What was our expected move? Or I think our expected move was 386 or 83. So again, our 50-day moving average should act as a level of support, and it does, and it is inside of our expected range. So that tells us that it's fair game, that it's in the realm of probability. But look at our 100-day moving average. A 100-day moving average is 356.68, well outside of our expected move. So if I'm a conservative trader and I wanted to put on a naked put strategy where I didn't want the fear or the risk of assignment, this is probably a better area to look for a particular strike combination. Now, there are a couple other things here that we can look at that are going to help us in our process. One of them is ATR. Now, I'm going to show you an example how we're going to use ATR on our day of action. But let's just remember, for Tesla, our 20-day ATR is 17. Our RSI. So RSI is kind of a measurement of volatility, kind of the speed of a market, and a little bit of momentum. So, again, if I'm looking at an RSI that is 70 or greater, that is a stock that is, accelerating to the upside. Now, that could increase volatility, which would increase the price of puts. But, again, I want somebody who's willing to buy a put. And so, I might think the sweet spot for RSI for us is somewhere between 40 and 60. I ideally would like to see a rising RSI. And there's this concept that in uptrending markets, the market will not fall below a 40 RSI. So if an RSI is below 40, that might tell me that there's more price depreciation to come. And then there's our trend seeker, or our proprietary bar chart indicator, which is a combination of a lot of different technical ideas. Matter of fact, we just did a webinar a couple of weeks ago, or I think it was last week, on the trend seeker. Again, if I'm looking at buys, then that gives me a higher probability that price is not going to go down. But if I'm an aggressive trader, where I'm looking to find some really deep discounts, then I could look at holds or sell combinations, but I better be very, very confident on my strike selections. All right, so let's go back to our example here. And what I'm going to do now is I just want to show you that you can, from here, just from here, you can go on this black plus sign, and that'll give you a chart. And again, we want to start thinking about where do we believe that, where we would be willing to buy, and also where do we believe that price does not fall. But you can also push here to get to a full chart. But I already got it teed up, and I want to show you a couple tools that we can have for us. So again, let's think about this. So where do I see support? Where do I think price should hold? And again, Tesla has been kind of in this range bound, and we can see that there seems to be some support here around 409, 420. Again, if I'm aggressive, I could look for some strikes that are in that vicinity. Where would be the next area? Where would I say, do I think that I would be maybe willing to buy Tesla? Well, I see a gap right here. And in gap theory, or in candlestick gaps, are called windows, and they act as support or resistance. So this could be a level of support around our 395. And where do I think, looking just at this chart, where do I think that in probability we're not going to go down to? Well, I would say probably down here, right? Right where we recently broke out of a previous trading range, and that's down around 357. So again, aggressive trader would be looking probably in here, someone who is maybe willing to buy but wants to buy at a discount here, and somebody who is very conservative and believes that price will not fall down there will be looking for strikes around there. So if we go into our templates, and under bar chart templates, there is one that's called moving averages 50, 100, and 200. And again, notice that our RSI here is, even with this sideways action of this uptrending market, right? We're not getting below 50 and we're holding above 40. That's a good sign. Now, I would rather see RSI turn positive, but in this case, this is still a good sign in terms of RSI. Let's look at this in terms of our moving average. Here's our 50-day moving average. Again, probably a better level of support and an area discounted where I might be willing to buy. And where do I think that price is not going to fall below? Well, I certainly think this 100-day moving average right around that 355 level. All right. So we also have another tool for us to help us define strikes. And again, under templates, bar chart templates, go to the bottom one, which is called the long-term stop. And this one is going to give you a couple new tools. First of all, these green and red dots represent our trend seeker. So again, if I'm looking for an opportunity to pick a strike where I want to try to get assignment, but I also believe that is going to be supportive to my trend, then choosing a strike that is around our trend seeker, which acts as a level of support, might be a good value. In this case, it looks like around 420. So let's do that quickly. And I'm going to go back to our screener here. And let's see, there we go. There's the 420 put, right? Where my break even is at 398 and my discount to price is around 5.5%. So again, going back to my chart, do I see support around 400? And I do. I see some support actually above 400. And just below that, I do have the 50-day moving average. All right, let's do that. Let's look at the 50-day moving average. So that would be around 395. A 395 put is going to give me protection down to 382, right? A lot lower and well outside of my range, expected range. And if I'm right and I don't get exercise, I'm going to get 3.3% return on my collateral over the next 30 days. And then where would I be really conservative, right? Let's say ultra conservative. Well, below our 50-day would be our lower turtle channel, and that would be around 315. Now, I know it's not on the screen right now. I'm going to show you how you can get access to that one. But down here, what we might discover is that there is not enough premium for the collateral that I'm going to put up. That balance between premium collected and time to expiration. We'll look at that in a second. Okay. All right. So there's another tool that I want to show you in terms of making a strike selection. So let's go back to our screener here. And I've made the decision that I'm going to look at this 395 or 390 put because that's near the 50-day moving average. That's a good discount. I'm willing to buy. And, my downside protection is probably outside the realm of reality. But let's look at this 390, where the current price on the bid is 11.10. All right. Now, what I'm going to do is I'm going to make a jump here, and I'm going to go to Tesla, the stock itself. And here is our naked put. So I've already teed this up. Here's the 30-day strikes. I've already teed this up. And so this is what I was going to show you is the default view might not give you the strike combinations that you're looking for. For instance, on the screener. So if you come here, you can find, let's say, the best fit, or you can do the show all, okay? So again, that 315, right? What is our return, right? Less than 1%. Again, I'm not saying that you can't do this trade. You just got to realize that, you might get a better return somewhere else. But let's strike this down to our 390. And so you can see here that, again, the bid price is $11.15, and there is our potential return. Now, I'm going to tell you something, that when I came on this morning and Tesla was starting to trade, the price was around $10 and the return was about 1.2%. And so this is what I want to show to you, a technique that you can do. So let's go back to our chart. And I'm going to go back to my templates. And now what I'm going to do is pull up what we call our day of action template, which gives us our pivots and a little bit of technical analysis. So what we're going to do here is we're going to use these levels of support as areas where we might find a better price for our put. Remember, if price goes down, prices go up. And we talked about the average true range, right? The range that price probability will move in one particular day. So here's the technique you're going to do. You're going to look at the last candle from yesterday. Notice this is the 330 candle, or the first candle today. And you're going to look at which one has the higher of the two, the higher high of the two. And then what you're going to do is, in this case, it's 446. You're going to subtract the ATR. So what was our ATR? 17. So for demonstration purpose, 446 minus 17, that's around 430. But here's the thing. When I was looking at this morning, when Tesla was trading right here, that value of that put was only around $10. And that put delta, right, was, where is the delta? There it is. Right now it's 27 cents, but this morning it was around 11 cents. So for every dollar Tesla falls, the price of that put is going to increase by, in this case now, 27 cents. But I go back to my, oh, there we go. This is the one I wanted, yeah. That 350, there it is, that 350, there it is, 10 cents, 11 cents, 355. So for every dollar, it's 11 cents. And so if I can capture $8 of my ATR, well, then that put is going to increase in value by 80 cents. If I can capture the whole ATR, that put value is going to increase by, $1.80. So using this technique on the day of action with the idea of trying to capture a percentage of that ATR could help you find a better put price. In other words, not just taking the bid, but setting the price that you want to sell. So for instance, if the put price was $10 and my second level of support is now $7 lower, and I know my delta is 10 cents, and $7 is inside the range of my ATR, then I can set my value that I'm willing to sell that put at 70 cents above the current price. I hope that makes some sense to you. This is a great opportunity, a way to learn how to be patient on the days that you want to take a particular trade. Okay. Let's go back to our original screener. And I'm going to go back here to the set buildings, and I'm going to get rid of Tesla. And so the tack I want to do now is I want to talk to you about using naked puts as a way to buy a stock at a discount, all right, or discount to today's prices, right? So, let's say we have a set of stocks that we want to buy, or some that we've been watching, right? A particular, again, a watch list of stocks that I'm interested in. So what I can do is I can come to our screener here, and under the inputs for our filters, I'm going to scroll all the way down here where it says personal list, and I'm going to pick out a watch list, and then again, I'm going to pick out the underliners found on my watch list, not the options. And then here's all my different watch lists that I have, and I'm going to squeeze down, and there is the Magnificent Seven. So I'm going to click on that, and let's see what the results are. And again, look, Tesla pops up here because it's part of the Mag 7. And again, it gave us those options that we kind of already hashed out, that 390, 395, right? And then I could go and do that whole assessment of break even, expected move, trend, ATR, my volatility, and see if this is exactly the strike and return combination that I want to use. Now, again, if I'm looking for a more favorable probability, in other words, I want to get into a trade, remember our 420 put was right on our trend seeker value. And if price falls between 420 and 390 between now and expiration, then I'm going to get into this stock at a discount of 5.5%. That's our discount price. But most of these are out of the money, right? And again, if I want to be guaranteed or have a higher probability, I might go even closer to current price. But remember, we want to look at our break even and our break even price to make sure that we are comfortable owning that stock at that price. So, can I find some technical evidence to support this price? That price will not fall further, and where that price might look to me to be a bargain. So again, going to our profit and loss, let's use the 420, right? Again, where our expected move is, right, is as far as down as 380. So I know that anything between 420 and 380 is fair game. Our 420-day moving average, right, is now above current price, but certainly the 50-day is below it, so somewhere's in that range. But let's go back to our chart. And let's start from a fresh chart again. And so what are some other tools that we can use? And so one of my favorite tools is Bollinger Bands. And Bollinger Bands give us a range of probability. So I want to find a break even that falls on one of my Bollinger Bands. Now here I'm using the daily Bollinger Band. And remember our 420 strike? Well, notice how our 420 strike is just above our lower Bollinger Band. Now, at this point, Bollinger Bands are contracting, which could make me concerned that if we do get below our break even, and this one around 400, that would be a breakout of our bands, and that could be an increase of volatility. But for the more conservative trader, we could change our Bollinger Bands from daily to weekly. And on a weekly level, if we can find those strikes conservatively, again, that are near or on our mean in this case. These will probably be higher probability trades that price will not fall below. Again, here we can see on the weekly for Tesla, that median is around 360, where we looked at that 355 put combination. And certainly if price got down there, that would be a deep discount to current price, and a price that I'd probably be very willing to own Tesla at. But until the meantime, if price does not get down there, where is our put combination? Again, let's go back to Tesla put combinations. We're going to pick up $4.70. About a 1.33% return for the next 30 days, and that annualized is about 16%. And where are you going to get 16% return on your money in a bank account these days? Okay. All right, Gene, let me see. I see we got some good questions. I see you've been answering a lot of them.
Yeah, while John takes a moment to look through any questions that have been submitted, I just want to remind everybody that our option screeners, specifically, we're looking at the naked put screener today. Option screeners are part of a Barchart Premier membership. If you are not a Premier member, we do offer a free, no obligation 30-day trial. Simple setup. You can get in and start playing around with the screeners that John's showing you today, along with all those P&L charts. So take us up on our free 30-day offer. I think you'll be happy what you see. And back to you, John.
Okay, Gene. All right, so the question here is, does the analysis change, or if it's all for options, index options, for instance, the SPY and the Qs? Yeah, it's still the math is still the same, the probabilities are still the same, it's just a different instrument. Again, you think about an index versus an individual stock, right? You might not get the exaggerated moves that you see in an individual stock that you would see in an index, because an index, is the basics of an index is that diversification, and then it minimizes single stock exposure. So you have to probably, reevaluate or recalibrate what would be your minimum acceptable, maximum acceptable return, and also, those discount percentages. But again, I think a general rule we'll look at in a second here is, around 10%, because most corrections are around 10%. All right. Earl asks, is there a replay to what we just did? Yeah, all webinars will be on our archive page before the end of the day. Or if you're watching on YouTube, you go to our YouTube channel and you can find them in YouTube as well, Earl. Okay? All right, so let's do this. And Gene, I see you answered a lot of questions for me today. I appreciate that. Thanks so much. Okay. All right, so let's talk about some takeaways before our time runs out. And let's talk about takeaways for our income generation. So first of all, out of money strikes will provide us that lower probability, right? Not getting exercise, and also that give and take that, the lower we go, also lowers those premiums. So there's that balance between premiums that we're going to collect and that probability of not being exercised or becoming in the money. Muddiness, again, I think this was a question that we just got. Look at a muddiness that is greater than, let's say, negative 10%. Again, most corrections in markets and in individual stocks are moves of less than 10%. Our potential return, right? Again, for income generating, we want to kind of look in that 1 to 2% for every 30 days, that minimum, maximum acceptable return. Timing opportunities and with high implied volatilities, again, our rank and our percentile. Again, I said, we want to kind of be in that kind of that temperance zone between 30 and 70. We just want to make sure that our implied volatility is above our historical. But there are two other factors here that I didn't even talk about, is heightened VIX. That helps push up the value of puts, and put volume activity. So let me show you that. So go into your options segment on your individual stocks and go to where it says put call ratios. And look at the expiration date that that you're considering. Again, I think we were looking at the November monthlies, 30 days out. And for today, you can see here that of our total volume, we get about an equal put to call ratio. But if I could find a day where I see this ratio is above 1, that is a good day. That is a good day to put on a naked put strategy, because that's telling me that there are more put buyers than call buyers, and that those put prices could be inflated. All right. Break-even price should have some technical support. So what are some of those technical support? So for income generation, probably want to be near the 100-day moving average, or around our weekly Bollinger Band mean. If you want to look at a daily and you're a little bit more aggressive, then again, that lower band on the daily. Again, our moving averages, and then again, just classical support and resistance. Old resistance becomes new support, or finding support on the bottoms of ranges or the tops of breakouts. And so for discounting entries, again, our purpose here is we're going to try to purchase a stock at a discount from today's market price. Again, think about the strike and the break-even price. And is that break-even price a value that I'm willing to buy at? And look at the difference between the strike price and the break-even price in that return based on the premium is that discounting price. Okay, at the money or in the money will provide us both higher probability and higher premium calls. Potential return, again, that is our discount coupon. Timing opportunities, again, elevated rank and percentiles, VIX, and put to call. But also remember, on our day of action, ATR is a tool based on volatility. And so taking that template, that one I showed you, the 13 EMA with pivots, and doing that minus ATR extrapolation and looking at where those pivots are, and patiently say, hey, as long as price is falling, let's wait for a better entry, a greater price premium, and find those that correspond with, let's say, half of our ATR or 2/3 of our ATR, and that'll give us a little bit better return. And I'm going to tell you, just a few cents or $1 will make a huge difference in the return. The example I showed you in Tesla, where I was set up this morning, the return at the pivot was, well, about 1%, and the return later in the day, as Tesla had fallen to the ATR, was closer to 2%. Again, look for break-even price should have some kind of technical support. And so for discounting entrants, I would concentrate on the 20 and 50-day moving average, the daily lower Bollinger Band. Again, our trend seeker is a great tool to look for those opportunities. And again, that price conversion with delta and ATR. And so the last question we should ask ourselves in both of these scenarios is, where do I want to own the stock, or where do I think price will not fall below? Okay. All right. I hope you guys enjoyed today's session. I know that I did. Gene, great helping me out. I appreciate all that you're done. So next week we are off. Yay! It's Halloween, and we're going to do some planning. But here's archives. The question is, where do you find that? You go in archives, and there you can see how to get pay and naked puts. That will be up. That is up. Will be up later today. And if you go into that, you also can find the slides that were for today as well. So we'll be back in 2 weeks. And so it's important for you, if you want to know what we're going to do, you can always sign up for, here's our upcoming webinars, and you can give us your email address, and we'll notify you once that webinar has been designed or has been posted. Okay. Until next time, folks, best of health, manage your risk, and the good of all trading.